earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
Good afternoon and welcome to the School of Cash Flow podcast. I'm the host, Dale Corpus. So this episode is about the topic of whole life insurance and unlocking the power of whole life as an asset. And I'm so excited to introduce to you my guest today. His name is Tom Wall. Tom has established a reputation as an award-winning advisor and top-notch sales and marketing leader with 20 years of experience in selling whole life insurance and competing against alternatives. Tom is now a sought-after coach and consultant, hosting the Whole Life Mastermind study group and authoring game-changing books and content. He's a thought leader in the space and firmly believes that participating in whole life insurance from the right companies is the best kept secret in financial planning. So without further ado, welcome to the show, Tom. How are you?
Fantastic. Thanks for having me, Dale. Really appreciate you being here.
Thank you. And just for my audience that doesn't know you yet, where are you based out of geographically?
In the Boston area. So desperately waiting for spring to come this time of year.
So how did you get into the life insurance business? What's your overall story of how you got to be where you're at?
Yeah, it's a great question. I joke around that no little boy grows up expecting to be the life insurance expert for life insurance advisors, but here I am. Honestly, it's how a lot of people get started in financial services. I was plucked right out of college by one of the big major mutual life insurance companies, frankly, to get licensed and sell life insurance, under the guise that, I would become a financial advisor, talking about all the different investments and ways to grow wealth over time. Shortly after that, I actually joined another Fortune 100 company's home office and kind of became their in-house life insurance expert. They call them a wholesaler in my business, and spent a long time doing that, maybe 10 to 15 years working with thousands of advisors all over the Northeast, and then toward the end beyond. So, a few years ago, basically made the decision to leave corporate America, from a relatively cushy role, took a big risk and said, I really think this is a story that needs to get told. The industry is not telling it very well. There are a lot of people telling the story online, frankly, incorrectly and misleading ways that are not good for the consumer. So thought I'd leverage, my skill set and my background and years of experience in a way that could serve investors, serve clients, but also help advisors tell the story in a way that was both responsible and meaningful to clients.
Okay, got you. What kind of folks do you work with? Do you work directly with clients? Do you work with advisors, or you work with both? Or, tell me more about that.
I've just recently published my first book called Permission to Spend. That's kind of my first foray into the consumer aspect. So most of my career has been working with advisors and kind of getting into the nuts and bolts and some of the deep technical aspects of the product and how to make it work, how to fit it with a client. I think my next phase, which is just beginning now, is actually taking a lot of those messages and, boiling down very complex messages in easy to understand ways for clients. So this book called Permission to Spend is really my first foray into that.
Okay. And then, so for Permission to Spend, who is your target audience for that? Is it someone, looking specifically for whole life insurance, or is it just, somebody just trying to get more financially educated, or tell me more about that?
Yeah. The whole reason behind the book is there's a big problem that most people don't know they're going to have. Most people are saving money actively into their retirement accounts. Maybe they're doing some real estate investing or something like that. But the vast majority of people are going to work and just saving. And the problem is when you get to retirement, you're going to be terrified to spend that money. Like, you don't know it, but you're going to be, even if you have $2 million, you'll be terrified to spend that money because that's the last money you're going to earn. You essentially, if you lose a lot in the market and you're spending money and now your pot of money is less, very, very scared very fast. So who this is for is really for the pre-retiree folks, kind of the people, really any age, but 40s and 50s, maybe 60s, who are preparing for retirement and trying to figure out what their overall strategy is, and incorporating actuarial science, aka insurance-based strategies, as a permission slip to go spend and enjoy those years of investments that you've accumulated.
Okay, that makes sense. And for folks that are just kind of new to the what life insurance is about, kind of give a high level overview of life insurance, because I know there's different types. There's whole life, term life, universal life. And I know that your main focus is on whole life and there's strategies, around there. Can you kind of just explain just, high level of why whole life makes, like why the focus is on whole life?
Yeah, absolutely. So there's really two major types of insurance. There's temporary term insurance, and then there's permanent life insurance, which is, so I say it pays out. The first one pays out if you die. That's kind of like you buy a 20-year term. So if you die in the first 20 years, your family gets paid. That's usually pretty inexpensive, and everybody should own it if they love other people in this world that are dependent upon them. The other one is permanent life insurance. That's really, I say that pays out when you die. So that will pay out 80 years from now if that's when you finally die. And that's typically, and because it's a guaranteed payout later on in life, that tends to be a much, much, much higher premium payment. But as part of that package, you get cash value. So this is really where when you think about alternate investments and where a lot of the press has been around this, is it builds a cash value on a tax advantage basis. So as it grows, you don't pay income taxes on it. And as you start to recognize gains on it, you don't pay income taxes on it. So that cash value early on is relatively small based on what you've paid in. But over time, there is a point in time where that cash will, on a guaranteed basis, exceed what you've paid in. And then through, there's a handful of companies doing it really well. They're paying participating dividends, they call it, where, over time, those dividends will get reinvested back into the plan. And you can see, 4, 5, 6% annual returns on that without any taxation, without a lot of risk. So there's universal life, there's whole life insurance. These are all different flavors of permanent life insurance. I personally, on all my experience and all that I've seen, I focus on whole life insurance because of the guarantees. You can't actually lose money in it. It must go up in value. The only question is how fast. Whereas some of those other flavors out there, there's a lot of good sales pitches around them, but none of them really have any guarantees over the long term, which, if you're going to be putting in tens or hundreds of thousands of dollars into these things over time, you want some certainty, especially when it's a plan called insurance.
Okay, that makes sense. Say somebody has a different type of policy, such as like a universal life policy or whatnot. Are they able to, do they need to start out? Like, how does it work? If they had one, can they convert some of that or all of that even to like a whole life policy, or do they just have to start a brand new whole life policy?
Yeah, absolutely. It's not a conversion, actually. So if I want to correlate to the real estate world, there's 1031 exchanges. You sell a property and you can roll that into a new property. Same thing with the insurance space. It's called a 1035 exchange. So if you decide that there's a different type of permanent policy that you want, you can actually transfer all of your cash and your cost basis over to a new policy, depending on how your risk tolerance or objectives have changed. So absolutely can do that.
And in terms of, getting started in a whole life policy, I guess it's two questions. Like, where do you recommend that people start, starting a whole life policy? And then when do people most oftentimes end up doing it in their life, in their stage of life?
I find that there's a few different people that fit the bill. There's the crowd I kind of talked about, the pre-retiree crowd, the 45 to 65-year-old crowd, give or take, roughly speaking. These are folks that are getting into it. Oftentimes they have very big death benefit needs. They have kids they're putting through college, they have dependents, they have reasons to own life insurance for sure. But what they're really doing is they're building an asset that's guaranteeing a legacy to their family and maybe guaranteeing funds to pay for potential long-term care claims in retirement. But it's really building a war chest of cash. And it's really where this fits. I hear this a lot. People try to say, should I do whole life insurance or should I invest in stocks or real estate or pick an investment? And the answer is it's not the right comparison. Whole life insurance is a better alternative to cash and maybe bonds. Very safe, conservative, accessible stuff. Because of the tax advantages and because of the guaranteed growth, that's where it fits. So going back to your question, if you're talking about the pre-retirement crowd, even if you're in your 40s and you're super aggressive, there will come a day when you're not going to be that aggressive because you're closer to retirement. You're going to want to start taking risk off the table, moving money to cash. That's where whole life insurance is a great fit. And it'll actually allow you to, because it's giving you bond-like returns without the risk, because of the guarantees, you can maybe be more aggressive or stay more fully invested longer. The other crowd, especially when it comes to real estate or just making business investments in general, we find a younger crowd in the 30s and 40s or something like that, looking at whole life insurance, overfunded designs as a way to build cash, aggressively, almost as an investment. Although, life insurance is the first piece, and that's always important. What I mean by overfunded is I talked about the tax advantages. These policies have incredible tax advantage, meaning, the money's going to go in after tax. kind of like a Roth IRA or something like that. So you will pay income taxes before it goes in, but if it's structured properly, you'll never pay taxes on any of those gains ever again for the rest of your life. Even if it's 80 years from now and you've multiplied your money by 10 times, the IRS won't get a nickel of it. And that's the amazing tax advantage. And unlike retirement accounts or other vehicles, you don't have to wait till 59 and a half to access it, or you don't have to wait till retirement or use it for a specific purpose like college. You can pretty much get it whenever you want. So what a lot of folks do is in this market is, and not necessarily younger markets, really any age, is what they'll do is they'll actually fund these policies way above and beyond what's required, up to the IRS thresholds of what's allowed to get these tax advantages. That's what I mean by overfunded. It's essentially you're paying more than you are required to for the death benefit on purpose because of those tax advantages for cash. And what folks will then do is they'll use that cash to then basically make a down payment on a property, and then using a policy loan provision and then pay it back, or they'll use it to make a business investment. On the individual side, there's a lot of applications on business side and estate planning, but for just the kind of the bread and butter individual investor side, those are really the two big markets that we see.
Okay, I got you. Yeah, I do have a handful of friends that use their whole life policy, as a, placeholder. It's pretty much like almost like their own, form of banking, so that they can pull money from it as needed, because the rate of return is a lot higher than you would get at any bank account. And what I'm liking from whole life versus a lot of the other stuff is the fact that it doesn't go down in value, like you were saying. Along the same lines, it's just like, what is your take on that, that infinite banking concept? Even a lot of real estate investors, they talk about this concept too, and that's how I'm familiar about it too. But what's your take on it overall?
My issue with infinite banking isn't so much the concept; it's all of the phrases and the wording that goes around it, including the words "infinite banking." I mean, it's not a bank; it's not infinite. I mean, you are subject to IRS limitations and what you can afford for sure. And what they'll say, there's a lot of terminology that gets tossed around, like you're paying yourself, you're borrowing from the policy and you're paying yourself back, and you're really not. You're paying some of that interest to the insurance company. There's a lot of nuances around it. That said, I haven't had $1 in my savings account for the last 15 years, because I own substantial amounts of whole life insurance. I use my whole life insurance essentially as an alternative to savings, because right now on my policy that's now 15 years old, when I look at my annual statement year to year, my cash values are growing at about 5.3% this year, and last year and the year before and the year before that. So it's very predictable. It's very stable. And I talked about loans, this is probably the biggest stigma when it comes to life insurance. For the uneducated, they'll say, well, wait a minute, you have to borrow your own money and pay interest? That sounds crazy. But essentially, the concept of infinite banking is when you have a mature whole life policy like mine, it's been in place for 15 years, it's growing at, north of 5%. And I borrow against it at, 4 or 5%, whatever the number is. It's usually pretty similar to the growth rate over time. It fluctuates, but over time, it's usually pretty similar. The idea is that policy and loan is treated as a tax-free transaction from the IRS's eyes. Just like if you borrow money on a credit card or borrow money elsewhere, you're not going to pay taxes on that loan because you're paying it back at interest, right? Mm-hmm. And that's the magic of these strategies, is if you can borrow against your asset at rates similar to the rate it's growing at, that's the infinite piece, is you're essentially putting money in and out, rinse and repeat. And over time, you've always got this life insurance benefit. You've got an underlying cash value that's growing. You've got dividends that are being paid. So I think it's a phenomenal strategy. It's way better than having money at the bank earning next to nothing, and then you're paying taxes on the next to nothing that you're getting. Now, otherwise, if you want to get yield, you're probably going to be buying bonds or taking some sort of risk. And again, you're paying taxes on that. And it's just a much more elegant way. The other piece is, in some of my studies academically toward the end, I started doing some research on whole life insurance as a fixed income alternative, essentially an alternative to owning bonds in a portfolio. And what you'll find is these big mutual life insurers, the dividends that they're paying, the growth that they're paying on these policies is all based on essentially what they're earning in their investment accounts. They have a big pot of money, hundreds of billions of dollars invested, mostly in long-term corporate bonds and such. But through the life insurance contract, they guarantee that your values are going to rise on a year-to-year basis. But then they'll give you outsized performance on top of that based on what they're essentially their giant bond portfolios earning. So through the contract, you're getting essentially, over long periods of time, bond-like performance, but the company's insulated you from loss through that contract. And I think that's why infinite banking, I'm careful with that term, because the big companies don't like that term. They don't like it because people sell these policies as cash first, and they kind of ignore the fact that life insurance exists. Mm-hmm. And in reality, you're paying significant costs inside all of these plans, no matter how you set it up for that life insurance. But done properly, at a younger age, just like myself, you oftentimes will get to a point where you don't even need to have a savings account anymore. It can be that.
Okay, that's awesome. A lot of, and I'm glad I brought you on the show because this is like the first time I'm having somebody talking about just life insurance in general. It's like a lot of the stuff that you're teaching, it's not really talked about, or just a lot of people don't have a lot of education on it because there's not so many trusted resources about it. Where would you recommend that consumers go to get even more information about this? Is there an actual, like, are there sites, or there books, or how does somebody go about learning even more?
Yeah, it's a great question. So that's essentially what I've done with my book. You can go to permissiontospend.com. I actually have, over the course of my years of working with thousands of advisors, I have a handful of advisors nationwide that I'll refer people to that are very familiar with these strategies and how to set them up properly. If you don't want to talk to me, that's fine. Generally what I would say is if you want to go to whole life contract, go to one of the big mutual carriers, the Fortune 100 companies. So Northwestern Mutual, Mass Mutual, Guardian, Penn Mutual. These are big mutual companies that have been around for more than 100 years. They're strong, they're stable, and the key is they're participating. Is basically, when you own a policy with them, as a policy owner, that's what the word mutual means. You're almost an owner of the company. The company operates for the benefit of its policy owners. There's not shareholders that are also taking profitability off the table. So that's where you want to look for. Their websites will direct you to folks, but I can direct you to folks as well through my website.
Okay, got it. But it's like, why isn't it that I feel like why do you think that it's not talked about as much, this concept? It's like you kind of need to go to a specialist just to even hear about it, more so than it just kind of being talked about more so as commonplace knowledge. What's your take on that?
Well, I think it's becoming more commonplace when you think about how it's being used. It's definitely widely marketed. I mean, at the end of the day, it's life insurance.
Yeah.
So it's not the sexy hot topic. You're not going to, you're not going to see people bragging about their 40% returns in it. No one's going to tell you how to, double your net worth using it. Frankly, it's boring. I jokingly say that every good portfolio, every well-constructed portfolio needs a mix of different assets to diversify. And some of that portfolio has to be boring stuff that you're not going to brag about, but it's going to go up every year. Whole life insurance, I not so jokingly say, is the best boring money can buy right now. It's got the best tax advantages. It's going to give you bond-like returns. People lost a lot of money in bond funds last year. They were surprised by that. Whole life insurance went up. It always goes up. And that's where it fits. So you don't see a lot of marketing around that. But the other piece is it's life insurance. It's frankly, it's illegal to market it for its cash value first. It's a life insurance contract. Death benefit should be marketed first. So the big companies are not, running commercials saying, hey, check out our cash value. It's actually against regulations to do that. So you're not going to see them do that. But, it's truly one of the best kept secrets in the business for exactly that reason. The ancillary benefit of that cash value, of the tax advantages wrapped around that cash value, is one of the best kept secrets in the business. And it's more impactful for investors who are either more conservative, particularly older investors or conservative investors who need that significant cash allocation to feel good and sleep at night, and also tax averse individuals or just high tax bracket folks. That's where a lot of those tax advantages really play well.
Okay, got it. What about, so a lot of people listening to this are business owners. What can business owners do in terms of strategic use of the capital as it relates to whole life?
Well, what we find is a lot of business owners have insurance needs. They have key individuals on their team where if that key, like, just think about if you're a small business and you have your top salesperson, they were with you from the start and they have all the relationships. And what if that person died? What would happen to your business? You might lose customers, but even if you can retain the customers, it's going to be very expensive for you to hire somebody else, to take their place. So what we see is a lot of key person coverage for those needs. That's a life insurance need first. But if you're a business that's keeping cash on the books, you can do double duty. You can essentially, insure the life of that individual who's a key to your team. There's also reasons to buy insurance on business partners. If your business partner were to pass away, then, there's ramifications there. But the cash value of the policy can be held on the business books. So it's an alternative to savings. It's in the short term, not going to beat your savings account, but in the long term, as you roll it year to year, it's going to start to perform much better with some great tax advantages. So I think we see business owner clients actually, being probably the top clients for it because they have the cash flow to fund it and they've got a lot of different reasons to own the insurance.
I got it. And then I wanted to also talk a little bit more about your book, Permission to Spend. Folks listening, access a copy of it. Is it available online, or how do they go about it? Getting it?
Yeah, I mean, Amazon, it's available in all formats, including audiobook if you wanted it. I think that we talked a lot about, the cash value and the investment aspect of life insurance in the last few minutes. But, the book is really driven at the retirement crowd. So all of us, are investing, we're accumulating wealth, we're saving, and we're all working toward a number. Everyone's got a different number, but at some point you're gonna hit your number and say, I'm ready to retire. I have enough money. Very few people, including advisors, a lot of advisors don't even recognize this issue well enough, is someday you will be at retirement's doorstep with whatever you've been able to accumulate. And you'll say, all right, I did it. I'm here. I accumulated my millions or whatever that number is. How much can I spend? And it's a terrifying question, and you're going to be afraid to spend. You might not think about it, but you will be terrified to spend that money. We see it time after time after time. Retirees are way underspending what they probably could, because look, you're not making money anymore. You're not working anymore. So if you spend too much and you start invading principal, and then the market crashes or some health scare, something bad happens, you're going to be terrified to spend. And it's a tragedy because 99% of the time, tragedy doesn't strike. And we see retirees actually getting richer and richer in retirement, which sounds good, but what it means is they're not spending what they've spent their entire life saving. So the book is all about, shifting risk. It's all about, guaranteeing a legacy for your kids. It's all about putting strategies in place to cover those unexpected health claims. It's about providing a source of liquidity so that if the market crashes, you can stay invested in the market and have another place, to pull from in those years. It's all about strategy. And done well, if you employ those strategies, 10, 15 years before retirement or more, you have a way more flexibility and choice in how you actually spend your assets. You can as much as double your lifestyle if you do it properly, based on the studies. So the book on a very high level goes through that. I think somebody told me that they read it on a 4-hour flight. So it's not a heavy lift, but it's available in all formats on Amazon. And you can always go to permissiontospend.com too, if you want to connect and dive in deeper.
Another question came to mind. So how would you respond to somebody that says that whole life insurance is a bad investment?
Yeah, I would say it's not an investment. It's an insurance policy. We talked about the best boring money can buy. Whole life insurance is an optimal replacement for cash and maybe a bond component of a portfolio. That's it. It's if you're thinking about it in terms of whole life versus stocks over the long run, stocks win every time. Real estate will win. Starting your own business will win. But any prudent portfolio, no matter who you are, should have some cash allocation, should have some bond allocation, particularly as you get older or as you get closer to certain goals. Even college funding, as you get closer to funding your kids' college, you're going to take risk off the table because you want to make sure that money's there and not wiped out by a market crash. That's whole life. Simple as that. So when people say it's a bad investment, I think that they try to paint the industry with a broad brush. There's a lot of different policies out there. There's whole life policies I never would buy, frankly. But if you're buying a good, well-crafted one, probably a little bit overfunded from one of those big mutual Fortune 100 companies, you really can't lose. Your worst case scenario is you may have done a little bit better elsewhere, but chances are, given enough time, that won't happen.
Got it. I have some final questions for you as we wrap up. So my first question is this: what are you excited about in your business right now?
What am I excited about in my business?
Yeah.
It's a good question. I think, this book is really my first foray into the consumer side. I've spent a lot of my career working with advisors and helping them tell the story. What I'd really like to build out is a set of resources and concepts that individuals can tap into and advisors can share with their clients. I think there's not a lot of that in the industry. You mentioned that a lot of people haven't heard about this. There's some good reasons for that, and there's some bad reasons for it too. There's a lot of bad actors out there putting out misinformation. So there are people that say it's a bad deal because frankly, some people are mis-selling it. So I'm looking forward to building upon the work that I've done, creating more for clients to consume, creating really resources for advisors to use to educate their clients. And I think that's where my strength lies. So that's what excites me so for the most part.
Very good. The word success. This is my next question. A word success, what does that mean to you?
Oh, it's a great question. What does success mean to you? I think success means living life on your terms. So, there's successful people that, can live off $20,000. There's successful people that can live off 2 million. So I think for every person, it's going to be different based on how you want to live. But, financial success, financial independence, which is really where I come from, it's all about living your life by design. So, to the extent that you can build a plan which gives you permission to spend, what you've accumulated on your terms the way you want to live your life, to me, that's success. And it's going to vary by person.
Very good. And last question is there anything that I forgot to ask you that I should have, or any final words for the audience?
No, I don't think so. I think if there's one thing to take away is if you have heard about whole life insurance, there's a lot of misinformation out there. You mentioned that some people may have heard it's a bad investment or it's a bad tool. In my experience, there's no such thing as a bad category. Categories of vehicles are generally created for a reason, to solve a need. It's when you misapply them. It's when you have a vehicle that's applied to do something that probably isn't best suited for. So a good example is like whole life insurance. There are some people that oversell it and they'll say this is the only financial vehicle you'll ever need to own, which is ludicrous. There are great ways that have been proven over decades or even centuries to generate a lot of wealth, like real estate, like equity investing, like starting your own business, things like that. Whole life insurance, though, where it fits is it's really meant to be that safe, conservative piece of your portfolio. And because of the advantages, when you really unlock how it works, are just unlike anything else out there. So I think the key takeaway is stop with the either or mindset and start with the and mindset of we're going to own a bunch of different things that work in harmony. In my opinion, that's really where I've seen the most successful clients excel.
What good words, good advice. And how can somebody get a hold of you?
Well, my personal website is at Tom Wall Talks. I do a lot of speaking as well. So that's kind of how you would find me individually. I can also, tap into me at permissiontospend.com. That's there as well. And of course, like I said, you can pick up the book or consume any of that content just through Amazon.
Perfect. Well, hey, Tom, thanks for joining me on this episode. That's a wrap. I do appreciate all your knowledge and insights about whole life insurance. And I know my audience will definitely get a lot of value from this episode. And to my listeners, feel free to reach out to Tom directly should you have more questions. Also, thanks for checking out this episode of the School of Cashflow. And remember to leave a podcast review as it helps me attract even more great guests just like Tom. So until next time, live life abundantly. Thanks, Tom.
Thanks for listening to another episode of the School of Cashflow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.